I want to welcome everybody to another Yahoo Finance Plus webinar, How to Invest and Manage Risk Amid Rising Economic Uncertainty and Elevated Market Volatility. And I think that speaks volumes about where we are today. We have a very special guest who's going to be joining us shortly, Michael Antonelli. He is a managing director and market strategist at Baird. But before we begin, just a couple of notes here. We're going to be talking about a lot of stock and market ideas. Past performance is not indicative of future results, and we're not trying to make any recommendations herein. This is for information purposes only, and we want you to get the most out of it. So we got some pre-registration questions, which we're going to get to. We encourage you very much so to submit your questions to us, and I'll try to get to them. And I think we are going to begin with a poll here. And I just want to get a sample of the audience and see, how long have you been investing and trading? Is it less than 1 year? Is it 1 to 2 years, 2 to 5 years, 5 to 10 years, or 10 plus years? All right. And as you make those selections, I want to welcome into the stream here Michael Antonelli. And Mike, let's begin with an overview of where we are, because we're in a bear market. There's no denying that, no matter how you slice it and dice it. Where you might be looking for a bear market rally, one of those flashy things that we get from time to time. But so far, we're just kind of barely off the lows here that we got to from last Wednesday, the FOMC low. And we know it's all about the Fed right now.
Not only that, Jared, if you were to look at the kind of total return for the first half of the U.S. stock market, the S&P 500 will primarily be talking about that. At least that's what I kind of lean into. It's on track for the essentially worst first half of a year since 1932. And now we're going all the way back to the Great Depression. And I'm sure that we'll talk about some other historical moments together, but you're talking about one of the worst starts to a year in history. So, you know, to put it into perspective, we've all lived through really crazy times, but none of us have lived through a first half this bad. I mean, this is ranking up there with the Pantheon. And you're right, it just boils down to the fact that can this market do well with a Federal Reserve who's committed to just absolutely tamping down inflation.
Yeah, and I want to talk about the Federal Reserve and the current market environment we're in and how different it is, in fact, from previous market environments. And I want to put a chart up here, see if I can get to it. This is going to be the 10-year Treasury note yield. Now, this goes back all the way to 1963. The peak here was in 1981, and that's when we saw the 10-year all the way up to 15.8%. By the way, Paul Volcker, who was Fed chair at the time, had raised short-term rates to 20%. So that is a massive inversion. But the big takeaway for me is the downward trend. Well, it's been kind of extent, but now we have a higher high. And that is the first higher high I think we've seen. Maybe this one we count too, but the first major one we've seen over a while. And this goes back 40 years. So if in fact the Fed is facing a new regime, if there's a secular change, what does this mean for investors? And is it surprising that we're seeing this kind of portfolio volatility?
Yeah, we just talked about the fact that stocks are doing really poorly. You know, first half of the year, bonds, same thing. You generally don't see a scenario where when not only the stock market's doing this badly, the bond market's doing this badly. And this chart is one of the most breathtaking charts in history, if you think about it. This is,
I agree.
You know, if you know, one of the things that determines an investor's kind of lifetime returns is frankly when they were born. Were you born into a period where the 10-year note is doing this? And you're right, look at that higher high. I actually put a tweet out on Twitter. I'm like, that's the first higher high in this channel going back to the 80s. So it definitely demands our attention. It demands that we have a take on it. It demands our view of as not only a strategist, but as an investor. Where can this thing go? I mean, that's ultimately a guess. I'm not, you know, qualified enough to say where the US 10-year yield can go. But I do think that, you know, we live in a world where crises happen. You know, they don't happen all the time, but crises happen once a decade, twice a decade, whatever. You know, I don't think this is a situation where this yield will just start skyrocketing. You know, you have another crisis and all of a sudden people rush into the 10-year and the yield starts falling again. So it does bear our attention, especially from an investing point of view.
Yeah, and your point well taken. We face crises all the time, but I'm not sure we've had the concentration that we've had recently because, you know, the pandemic, we had the fastest bear market in history, followed by the quickest bull market in history. It's easy to kind of miss that if you blink because everybody's locked up and worried about their livelihoods and what they're going to do with their stimulus checks. That was a different situation, but now we have this brutal bull. Reminds me more of the GFC, the global financial crisis, or the tech bubble bursting, and that has huge implications here.
Those are two things that, you and I have lived through. Maybe a lot of your viewers have lived through. Those are moments that are still kind of seared into our brains because they were so violently bad. The GFC was a moment where, we didn't know whether 100-year-old banks were going to, we're still going to be in business, whether the economy would still be churning along. So yeah, this does feel like a combination of a bunch of things. I'm a history buff. I'm a history undergrad on top of my kind of my graduate degree in finance. So I like to tell stories. We can tell some today.
Yes.
But yeah, this feels like an amalgamation of a couple different things. It's never exactly like the past. It's not exactly like the dot-com collapse. It's not exactly like the GFC, but we're seeing moves that are so violent that they will be remembered the next time this happens, and we're on, we're talking together about whatever the current, news of the day is. But yeah, this is something where we're going to remember this one for a while.
Yeah, and as Mark Twain wrote or penned, history rhymes, and it certainly does. I didn't know you were such a history buff.
Yeah.
I suspected it, but we were talking before the show and offline about the parallels between now and World War II, and a number of interesting ones, because the Fed back in the day, they were pegging long-term rates. That's yield curve control. That's what we're thinking is around the corner. They controlled the entire yield curve. They held the 10-year to 2% or 2.25% for years and years and years, while the U.S. financed its war deficits. And I have some interesting graphics here. I just want to get your take as I put these graphics on the screen. Maybe you can just start sharing.
Yep. Absolutely. Yeah. I mean, when it comes to the historical analog, World War II is the biggest event that kind of rippled through history. You could even say World War II is kind of one of the seminal moments in human history. Think of all the things that came out of it. You're talking about all the inventions, all the change in geopolitics. It was just a massive world-bending event. And there are some parallels. We talked about it earlier. We're looking at a chart right here of the US inflation rate post World War II. What you'll notice is that it soared. I mean, the inflation rate was averaging about 3% during the war. There were certainly rations. There were wartime rations and restrictions. But after the war, you'll notice there on that chart that the inflation rate spiked to 20%, right? We're at 8%. People are losing their minds over 8%.
And rightfully so.
It spiked to 20. Why was that the case? Well, once we lifted these restrictions, these wartime restrictions, American consumers, these GIs who had come back from the war, were trying to catch up on years of pent-up purchases. So Jared, check this out. From 1945 to 49, all right, which is the period we're kind of looking at here, American households bought up to 20 million refrigerators, 21.5 million cars, and 5.5 million stoves. Remember, the population in the United States at that time was about 139 million Americans. A lot of those are kids, by the way. This 139 total. So we're talking about, greater than 10% of the population rushing to buy things. Does that sound anything like maybe something we've been through? The GI Bill puts money in people's pockets. So inflation soars because people were kind of catching up on pent-up purchases, essentially.
And let me show you another table. This was an interesting coincidence because, as I told you before, I was looking through the data of the 1940s by hand. I was reading old statistical volumes. The Census Bureau publishes them all the way back to 1870. And you really get a flavor for the market environment of the time by reading some of these source materials. As you said, there were price controls. There were huge meetings and offices dedicated to providing ration cards. But if what you're looking at the screen here, what stands out to me is back in the day, they used gross national product instead of gross domestic product. We don't need to dwell on that. But these national accounting identities were fairly new at the time. In fact, I think they were commissioned by Winston Churchill to justify longer-term deficit spending because of the war. So you had Keynes, you had some British statistician develop these identities. And look at the growth. You got 1941, almost 25%, 42, 27. And then it trails off here. Finally, by 49, it looks like there was a return to normalcy. Maybe they didn't want to see outright contraction, but what do you make from this, the volatility here, just in terms of what was produced?
Think about the sheer war effort. So there's a story that President Roosevelt went to the airplane makers and he said, how many bombers can you build in a single month? Because, we need to build a lot of bombers for this war. And the airplane makers say, we can build no more than 5,000. That's it. That's the most bombers we can build in a single month. And Roosevelt tells the airplane manufacturers, well, next month you're going to build 25,000. Next month you're doing 5 times as much. And they did. And you can see it in those numbers. Essentially just the economy just started soaring. And the point of this story and these lessons is that, on the backside of that, they had a couple recessions. In 1945, there was a pretty nasty recession where the economy fell about 11%. You stopped producing that massive amounts of war goods, but then the private sector ramps up, inflation spikes, you get another recession. And so the recession of 1948, the economy levels off and we get about an 11-month recession with a 2% drop in GDP. That's that one that you just pointed out on there, about a 2% drop. It ended up being a pretty mild recession. Unemployment spikes to about 8% during that time frame, but the recession's pretty mild as we're coming off of that spike in inflation. Again, does this sound anywhat similar to maybe what's happening now? I know it's not the same. I'm not here to say it's going to play out the same. I definitely am not. But you put a bunch of money into an economy, these goods become scarce, inflation rises. Certainly we know more about Fed policy today than they did back then, but we did have a mild recession, and then inflation actually fell into deflation. It actually fell from 20% into deflation in the early 50s.
Yeah, and there was a huge reorientation of the I guess, a global economy. The US was less shell-shocked than the rest of the world, and the rest is history. But I think the main point is there was a huge reorientation of the status quo, and it took a while to figure out what the next status quo was going to be. I want to get now to our poll results for the first poll. Less than a year, only 6%. 1 to 2 years, 24%. 2 to 5 years, 9%. 5 to 10 years, 12%. And the biggest response by far, 10 plus years, 50%. We got some veteran investors in here, some people who know what they're doing.
They lived through some things, I'll
tell you what, everybody needs help, including me. And we're going to get that to you. I want to run our second poll here, and that is going to be, what's the difference between a bull market rally and a bear market rally? So the first response, bull market rallies favor quality names. Bear market rallies, this is second response, bear market rallies occur amid higher volatility. And then the third response, you know it when you see it, in other words, with 2020 hindsight. And the final response, the banners on financial TV make it clear, because that's the way they roll.
Those are good.
I want to get to some questions here.
Sure.
And we've been talking about the backdrop. I want to get to some specific stuff. What are some recession-proof investments, the sectors you're looking for, investment styles? This comes from Phyllis.
It's an interesting question. It's certainly one that I would field all the time from clients of my firm, of Baird. People always want to know, like, in difficult times, what should I be thinking about? And, I don't believe there's anything truly recession-proof other than cash. It's like somebody asking you kind of, what's the safest instrument? And ultimately that just ends up being cash, because it's something that can't break kind of when the world goes crazy. So the way I think about asset allocation right now, I'm thinking about kind of high quality dividend sectors. I'm thinking about quality names, good companies who are continuing to grow their businesses through these moments. I'm not the kind of person that completely abandons equities when the stock market gets going really tough. I think there's certainly some digging you can do through those kind of sectors. What other kind of recession-proof things? A lot of people, some people look into real estate, but again, these things can be kind of dependent on interest rates, and interest rates can be kind of problematic during recessions, or they can be tough to kind of predict and go through. So, as I'm trying to think about where I would want to consider these investments, A, I want to know a little bit about you and your time horizon, but B, I'd like to focus on good companies who continue to grow their balance sheets, quality names. I don't think you need to get too what would call away from home in times like these, which means reaching for kind of risky names. I think it's okay to kind of to focus on the kind of consistent growers throughout history.
Yeah, I think that's a really important point. Quality means so much here, because a lot of these companies that we're seeing, especially the smaller ones, even some of the smaller high flyers that were probably one of the ARC components, a lot of these guys aren't going to make it simply because their cost of capital is going to go up because the Fed is raising rates. I read an estimate, this was before the beginning of the year, that something like nearly 20% of the companies in the Russell 2000 were zombie companies, which means they can't cover their interest payments with their profits. And that's a big problem in a rising interest rate environment. So I think it's going to be, a lot of analysts are saying this is a stock picker's environment. It's probably going to be that way for years. So I'm wondering what you think this means for passive investments. 60-40, is that simply dead? What does an investor do?
No, I don't. We hear it all the time, Jared, in the circles we run in, that 60-40 is dead. You could Google that term and you would probably see that article written maybe every few years for the past decade. So it's definitely something that we hear quite a bit about. You would think 60-40 money, if you're going to deploy 60-40 money right now, it would be one of the more attractive moments in recent history. Right now, all of a sudden, your bond component is in the threes, and that's a nominal, right? That's not a real yield. Your bond component's in the threes, and the stock portion, certainly we've had a tough start to the year, but as the stock market falls, its future expected returns tend to rise. So I don't think a 60-40 is necessarily dead. It's just going through a really difficult moment where they're both falling at the same time. And that's rare. I think I looked into history, Jared. It's only happened like 3 times where both stocks and bonds fall at the same time.
Yes, and this is, I think, by far the worst in at least 50 years. And by the way, I mean, the worst start to the stock market since maybe one other since the 1930s. Basically, nobody's seen this, and I think that's another important point. But what I like what you said there about the 60-40 trade is probably a good time to get in that. If you're already in it and you suffered this huge drawdown, that stings. But I just want to show something here. I did a little study a week ago, and I wrote an article about it. And this just shows, excuse me here, it's going to show what happens when we have a market decline and basis what happens during others. And I'm trying to find it right now. We'll see if I can get it. There we go.
Yeah.
All right. So this goes back to 2008. This is going to track the downturn that we saw in the global financial crisis. And in that time, from a high to low, we saw financials get sold off the worst, 82%. That is incredible. That's how much tech lost in the tech bubble. Yeah. Industrials, materials also suffering. You take a look at what happened next. Well, financials were the leader in the next bull leg, up 174%. Guess what happened after that? We had that scare with S&P downgrading US debt, and financials down 34%. But guess what? When stocks found their footing, financials third place, up again. My point is that a lot of times what gets beaten down the most oftentimes leads on the way up. You just want to skip the middle part where you unfortunately get stuck in that trade.
I actually looked at kind of the 10 worst calendar years in history for the S&P 500.
Yes.
There was a chart kind of produced by our friend Ben Carlson of Ritholtz. He looked at the top 11, but if you looked at kind of the 10 worst, and they're bad, right? You're looking at down 40 in the Great Depression, down 30 in GFC. If you were to look 5 years out, there's no negative from the top 10 worst single calendar years in history calendar. There's no negative returns 5 years out. Now this, past performance, no guarantee of future results, like you said, but it kind of goes to your point, which is that as bad as things get, the expected future returns definitely start to rise.
All right. I want to get to our poll here, or the results of our poll, and then Mike, we're going to do another one. I was talking to my producer, Mike, get our poll 3 ready. So the results of this, and what's the difference between a bull market rally and a bear market rally? Well, only 6% of the people said bull market rallies favor quality names. I think they favor almost all names, especially the low quality names.
Yeah,
so a little bit of a trick answer. Yeah, bear market rallies occur amid higher volatility, kind of the obvious answer. 69% of people said that. When you see it, 2020 hindsight, 22% of the people. I'll tell you what, sometimes you really don't know until you're at record highs, or you don't believe it when you're back up at those previously high levels. And that's when the FOMO kicks in. So possibly that could be one. And then the banners on financial TV make it clear. We had one person say that. I'm thinking that's a joke. And I want to get to our third poll, and that is, at this stage in the business cycle, early tightening, which is early tightening to fight inflation, what asset classes tend to underperform the most? So which is going to underperform, be the worst performer? Stocks, bonds, commodities, volatility, real estate? And it is a nuanced answer. So
this is definitely a tricky answer, a tricky question.
And we'll get the results in a couple of minutes here. I want to get to another question here. Thoughts on high yield bonds? This comes from Richard. Oh, so and also, go ahead.
Go ahead. No, go ahead.
I just want to say, we really want to encourage everybody to ask questions here. So if anything pops into your head, feed it to Zoom, and it will be fed to me.
So I'm not a fixed income strategist per se. Like I tend to try to think more broadly about investing and behavior in the markets for our clients and for my firm. But the way I use the high yield market, I try to look at it as kind of a temperature of a market that I don't participate in. And that's this gigantic entity that is the bond market. So I looked at, some credit indices, and I say, is this telling me something? Is it getting worse? Is it getting better? I kind of look for rate of change in that stuff, as opposed to investing in that space, because it's kind of outside of my lane, if you will. But I do look at the credit indices on almost a daily basis. There's lots of things you can use. You can use it, you can use the kind of over the counter indices. You can use an ETF if you really wanted to. But I use those as kind of, what is the other big market telling me about its feel for the current investing landscape? And we got a decent sized bounce in high yield. I think it was a couple of weeks ago, like a pretty decent sized bounce. And when that happens, generally that tends to be a good sign, but now it's kind of arced back over again. Like you're showing right here. Yeah. It's just, we got a really big bounce. And typically when you get that big of a bounce, it's a good sign for overall risk taking, but its reaction since then has been more of the, possibly just a short covering move and not a real meaningful move.
Yeah, I like this question from another Mike here. The Fed is the Fed simply going to hike until everything breaks? And we're looking at this chart here. You're right. This should have had some legs, and the fact that we got to new lows is just incredible. That shows you.
I agree.
That shows you the Fed is in kind of a predicament here. We knew that they were in a predicament, but maybe not how badly. And I think last week's FOMC presser, where Powell, you could almost sense the fear of inflation. They pivoted very strongly from 50 basis points to 75. And he explained that it's because we don't know what we're going to do next. Yahoo Finance's Brian Chung interviewed Dallas Fed President Patrick Harker earlier today. And he said, I don't know if it's going to be 50 or 75 basis points next meeting. The data is going to tell us. I think the Fed is so transparent and so dedicated to being nimble that itself causes a lot of uncertainty. Your thoughts on the Fed here?
Oh my gosh, the move, you could put up a chart of the 2-year yield if you wanted to, if we really wanted to blow people's minds, because the 2-year was moving like a meme stock essentially. Like the move after the around the Fed decision was like 50 basis points in the 2-year note, which is, I know that sounds fancy, and I know that sounds like, what does that mean in like layman's terms? But the 2-year note does not move like it just reported earnings. It just doesn't normally move like that. And that was when that high yield ETF started to turn over, because the market was completely wrong. It had landed on the fact that the terminal rate was going to be about 2 3/4. That I remember this distinctly, because I remember talking to another teammate about this. It had landed on the fact that 275 was going to be the terminal rate. And if you were to look at it today, the CME has a good Fed Watch website. The terminal rate has landed now at 350, 375. So it had to move almost instantly. And you're right. This is a good question. Are they gonna hike until they break something? Honestly, probably. Right. What other lever do they have to pull other than to try to all of us to stop doing things? They're trying to put the economy on ice. How do they do that? You freeze the housing market over, like Wisconsin in January. You just freeze it over, and that's what's going to happen at 6% mortgage rates. The housing market will just freeze in place, and that's their metric. That's their tool to kind of help fight this inflation, because they can't put more gas in pumps, and they can't put more bacon in supermarkets, and they can't put more Jeeps on the lot. So they just try to crush demand.
Yeah, and that does eventually work. It's just painful. And Powell was testifying before the Senate today, giving his scheduled Humphrey
Hawkins.
There you go.
Yeah.
Testimony. But Elizabeth Warren was coming out with some pretty good points. It's all politicized. It's an election year, but either the Fed is going to fight inflation, and by doing that, people are going to lose their jobs, or they're going to back off, and it's lose-lose, I think. There's not an easy solution to this. I want to get to the results of our poll number 3, and we'll get ready for our poll number 4 here. At this stage of the business cycle, which is early tightening to fight inflation, what asset classes tend to underperform the most? Stocks got 44% of the votes, bonds 24%, commodities 15%, volatility 6%, real estate 12%. I'll just say that it's a nuanced answer, and I think at this stage in the business cycle, it's commodities, volatility, real estate tend to outperform. So it's really just thinking about stocks and bonds, and those are very two big asset classes. As you've been saying, you watch bonds even though you don't necessarily trade them or advise on them. But go ahead.
I want to make one point that I think is important for us to digest, not only as people who spend our lives in this space, but also everybody kind of watching and listening. This event that we're in, if you want to call it an event, right? It's all due to COVID. I mean, this all started from a crisis, a global crisis. So one of the things that you need to remember, though, is we have a roadmap for this, Jared. Like the United States has experienced high inflation before. This isn't the first time we've ever experienced high inflation. There's a roadmap for this. What is there not a roadmap for? There's not a roadmap for a global pandemic. There's not a roadmap for 100-year-old banks potentially being worth nothing and the global financial system collapsing underneath it. There's no roadmap for an attack on U.S. soil after a collapse in the stock market. Those things were much more difficult moments in our history. I know this stinks to go through, but there's a roadmap to this. The Fed is deploying their roadmap, and we're starting to see the results of that. But that's what I want us to kind of think about, is that this what we're going through right now isn't some like left tail event. We have high inflation. We just have high inflation.
Yeah. And just back to the original point, what's going to suffer more, stocks, bonds, depends on, how you're invested in those instruments. Bonds tend to lose less money, but it's supposed to be safer money. So it hurts people more when they go down. So either one of those, I think, would be a good answer. Also want to get to our poll number 4. This is what happens if the 40-year downtrend in treasury yields reverses. That gets back to that chart that we were looking at earlier. Response number 1, growth stocks tend to struggle or value stocks tend to outperform. 60-40 underperforms versus its prior 40-year stretch. Powell gets less sleep, all of the above.
Yeah,
and the answers are pouring in.
I think the answer is obvious on this one. I think the answer is quite obvious. This is one that seems pretty pretty clear cut.
Exactly. All right, I'm going to give you a break here for about 5 minutes, Mike. I'm going to share my screen, do a little show about Yahoo Finance Plus for our members. And this is the first time, by the way, that we have actually restricted access here to only Yahoo Finance Plus members. We're going to be replaying this. We're going to get this out to the public with a delay, but you guys are the first to see this. So you're all members here. Some of you might be on a free trial. This is the dashboard. You probably know it well. I just want to get into some of the investment ideas and show you. This is one of my favorite parts of the platform here. And here's, for example, you have both technical alerts and fundamental alerts. And if you see a little chart symbol like this, and again, we're at the investment ideas here, you can sort by idea type, which is fundamental versus technical. And we just happen to have a lot of technicals at the top. But here's BJ, for instance. Looks like a continuing bearish wedge pattern. So let's click and see what that is about. And they're saying this stock has formed a pattern called continuation wedge bearish, providing a target price for the intermediate term in the range of $49 to $52, talking about a momentum oscillator, cross below zero. And there's some notes here. So let's view it in a chart. And you'll notice that the pattern is clearly outlined here, pretty slick. And you can see up here, we have short-term bearish, mid-term bearish, long-term bearish. So that is bearish on all time frames. And then we got some support and resistance, some stop losses. And then over here on the right is an explanation of that event. And you can click on that. You can also click on longer term and get a different set of indicators here. And also events. We have some that come with the platform, and then Yahoo Finance Plus has a bunch more. And this has to do with corporate deals. If you wanted to know what was happening with Tesla at the highs there, it was Elon tweeting. Well, probably going to be some kind of alert for that. I find that pretty useful here. Going back, and let's go back here to our dashboard and to our investment ideas. Maybe we need to click here. Yeah. Well, let's just do this. Boom. All right, there we go. We can also get some fundamental ideas. So let me just get some of those. You're not going to see as many of these during the earnings season doldrums because most of these are going to be based on recent earnings reports. Here's one for Coca-Cola. Coca-Cola has a bullish trend. And guess what? Coca-Cola is a consumer staple, so it's not getting hit quite as hard as some of the others. But this talks about their CFO, John Murphy, and the chief marketing officer. They spoke at an investor conference talking about disruptions from COVID, catalysts, et cetera, and just kind of giving an outline on a fundamental basis of what they see in the particular stock. So that's Coca-Cola. Here's one for JBL, Tyson Foods, Tech, et cetera. So these come daily to your mailbox, or you check. I think you get alerts for these. I usually use a desktop app because I'm old-fashioned like that. But let's go through some additional features here. I really like the community insights and how this is shaping up, something that I use personally. It's kind of based on the Yahoo Finance trending tickers. And give me a second here. If you watch our live programs, it's something we feature a lot, and it's basically crowdsourced. It's, what are Yahoo Finance viewers what are they clicking on? And this is kind of that writ large. So you have most visited companies, and by the way, Yahoo Finance trending tickers, it's free, but it's only updated on an hourly basis. This has more long-term signals in it. You can see these little spark lines when there's an increase in volume on a ticker page, and it'll give you insights that way. So you have community conversations. Lots of Yahoo Finance users, both plus and otherwise, upload their portfolios. And so you can get on an aggregated basis a view of what's changing in everybody's portfolio. So a lot of proprietary information there based on what we, just based on being the biggest business news platform in the business. So that's kind of a wrap up there. If you go back to the dashboard, I'm going to go to the dashboard. I like the risk level. That's something that's interesting to see, along with diversification metrics. You can see in my portfolio here, which I just kind of randomly put together years ago, heavily weighted towards communication services, probably not doing that well. But all in all, if you have a portfolio and you're trying to manage it here, we heavily encourage you to keep up your Yahoo Finance Plus subscription. And I do have a couple of comments here. I might not be able to answer this, but I want to address it. Did Yahoo get rid of personalized watch lists created by premium users? That's from Anonymous. I don't know, but I will check in on that and try to get an answer. I'm not sure how I'm going to get that answer to you, but follow my Twitter feed. Here's another question. Are high dividend yield equities a hedge right now? And I'll ask you about this, Mike. Are they sustainable? This is also from Anonymous. High yield equities. So we can imagine who that would be. Maybe some of the telecos, some of the safer companies, maybe some energy companies. What are your thoughts, Mike?
I don't like to use the word hedge with equities ever. It's just something I don't.
You don't believe in cash stocks?
The word hedge to me implies that you can minimize some sort of movement or loss or whatever. And equities all have their own idiosyncratic risks, whether it's, is a high yield stock a hedge if the CEO of the company ends up under indictment. So there's just so many risks involved with single names that I don't view them as a hedge against anything, frankly. And I think that's been proven throughout time. I mean, you just don't know what's going to happen to a single name. So again, I go back to this notion of if I was going to think about investing in times like these, I would focus on my goals and kind of my time horizons. And if I was going to do anything, I would focus on asset allocation before security selection. But if I was going to land in the security selection space, I'd focus on these kind of high quality names throughout time. I mean, there's companies that have lasted through all sorts of recessions. There's companies that have grown through the GFC. There's companies that grew through the dot-com collapse. There's companies that kind of have proven to be operators in difficult times. And those would be good places to start for me.
Yeah, and it kind of ties into our next question here. If you're lucky enough to be in a majority cash position, whether in your 401k or IRA, which ETFs or mutual funds would you recommend? This comes from AJ, and I know we're not trying to give personal advice here, and you're just kind of reiterating your framework, but this is something a lot of people, if you're lucky enough to have cash, it's when do you deploy it? And I'm going to share a chart here and get off the beaten path a little bit. This is going to be Cisco. And this goes back to a couple of years back. I want to put a max chart in so we can see. There we go. There's the dot-com bubble. And guess where it is now? Guess where it is now? Was never able to eclipse that. And that's what I think is going to happen with a lot of these stocks. Not all. So I said some of them are not going to make it. A lot of them are. And a lot of them are just going to be dead money for years, chop around. And then maybe in 5, 10, 15, 20 years, you'll see, there's that beaten down ARC component stock that I forgot about years ago. Now it's finally kicking in. If you have cash in your portfolio, what do?
I like, if you're lucky enough to have cash in your portfolio right now, I mean, I think that's frankly, one of the best trades of your life. If you're just sitting on cash at this moment when everything is kind of having one of its worst starts to the year. Retirement money, when we do financial planning for our accounts, for our clients, and when it comes to retirement money, that's generally long dated money. So I think that if you're looking at when should I buy, I think you should always be buying, frankly. I mean, this is a situation where if you need this money 20, 30, 40 years down the road, do you care about a blip on the screen in 2022? I mean, certainly it hurts to see the stock market go down, but anytime I'm dealing with somebody who is a client or not a client and talks about kind of long dated money, I remind them that, that the stock market has generally provided the best kind of long-term returns. I've even written about this. Yeah, I wrote
Right
about
there.
this blog right here. Yeah, this is my blog, by the way. Thank you, Jared.
You got it.
I said it's not different this time, and just the news might be different, but how you act in it and what matters in it is no different than '08. It's no different than 2000. It's no different than the '87 crash. It's no different than any of those. And that picture, which is a great image, I pulled off Twitter. I think it was Portfolio Visualizer. There was, no, it's from Visualize Value, which is a great follow. It's compounding. Like if you're trying to compound your money, do you want to stop it every time the stock market goes down? Right? Do you want to always stop your compounding, or do you want to let it grow over time? And I am one of these believers that all the great things in life compound: money, love, relationships, knowledge, all those compound only if you let them. So if you have cash in your 401k, that's congratulations. This is, as the market falls, it just starts to go further and further in your favor for long-term expected returns. You just have to understand that along the way, you're going to get another event like 2022 and 2020 and 2018, and you're just going to keep getting these as you go.
Best time to buy is at the bottom, but not to make light of it. It's dollar cost averaging over time. And I want to get to the results of our poll 4, and maybe we'll get to poll 5. What happens if the 40-year downtrend in treasury yields reverses? Growth stocks tend to struggle. 12% said that. Value stocks tend to outperform. 15%. 60-40 underperforms versus its prior 40-year stretch. 9%. Powell gets less sleep. 3%. All of the above. 61%.
Yeah.
And that was kind of, but let's talk about that. Why do growth stocks tend to struggle? And it's worth reiterating in this rising rate environment, it has to do with the higher cost of capital. But, I think, Mike, we've been in a 12 to 13 year environment of ultra low interest rates. And for that matter, they've been trending down for 4 decades. People, they need to get snapped out of old ideas. And that's what we see with the shell shocking in the portfolio and the upheavals. And it's not just retail investors. It's really the institutionals, Mike, because I see leverage just being taken out of the system. First, it was in bonds, and now it's in currencies. I mean, the Swiss National Bank, I think they raised by 50 basis points last week. First time since. It's incredible. And
the
these
90s,
moves,
I don't know.
Yeah, and these moves are important because the bond market, all those trades and all the FX trades are highly levered. And so when you have a deleveraging, everything goes. Even energy got hit last week for 6 or 7% because of margin calls. So that which works gets sold sometimes.
So if you go to my Twitter account or on my blog here too, you'll see that I wrote a blog called Grind Up and Crash. It's my pinned tweet if you're at Bull and Baird, if you go there. And the blog, I wrote the blog because that's how you should be viewing the world. You should be viewing the investment world, the stock market right now. Grind up and crash, which is we're going to have these moments of the market kind of slowly grinding higher as things get better. And then they're going to crash. The stock market will crash. Why will it crash? Because all information is freely knowable instantly. It's like my pinned tweet right there. It's how, grind up and crash is how you should be viewing the world. What people aren't going to wait. Investors aren't going to wait to see what's happening. They're just going to sell instantly, and they cause these liquidity cascades, and the market starts crashing, just like it did in 2020, just like it did in 2018, just like it did in 2022. Like all these years, we're experiencing the same things, and that's because we're all in one giant trade together. We're all just in one giant levered trade together. And as these things kind of fall, they fall really quickly. So, that it's super important when you think about this. And remember, so my friend Morgan Housel said this. I know you're probably a fan of Morgan Housel's, Jared. He said, he said that the price of a stock is just a number today times a story about tomorrow, which I think is a really good way to think about a stock. A number today times a story about tomorrow. Growth stocks are just all about the story. What will we be one day? We're going to be something one day. We're going to have a bunch of users one day, and people care about that story for long stretches of time, like we did in the 2010s. And then all of a sudden people care about the number today. They care about actual cash flows. And when that happens, it was the answer, one of the answers to that poll, growth stocks get crushed, decimated. I don't care where the subscribers are going to be 10 years from now. I need some cash flow today. So all of a sudden, when the cost of money changes, when the current value of interest rates changes, growth stocks just can't handle that.
And I mean, along the lines of what you were just saying, the story of tomorrow, I like to say that price precedes narrative. In other words, the market generally has an idea where it wants to go, and it just uses the daily fluctuations and the news cycle to kind of facilitate that move. But I think we're in an environment now where news is actually driving the market. Anytime we get
Yeah,
a
that's probably right.
8.6% print on CPI, that's changing the macro picture substantially. And so we're actually in one of those rare environments where the news is actually driving price. And I think people have to respect that, because that's why we're seeing, I was looking, I thought the market should have taken off, at least had a flashy bear market rally several times this year, and it was just stopped cold in its tracks. And you know, while I'm thinking, let me see if I can pull this up as well. I'm not sure if I'm going to have this. I don't have it with me, but I just want to, I want to end on a positive note here.
Yeah.
And it's kind of like turn off the news. Sometimes you just have to turn off the news. And I recognize that I'm in the news business. It may not be the healthiest thing for people to consume 8 to 12 hours of you know, negative headlines for the most part in a given day.
So I'm glad you said it, not me. All right, because you know, I have a lot of friends at Yahoo Finance. It's one of my favorite things to watch and participate alongside of. So I always do appreciate these kind of occurrences. Yeah, I mean, it's not just necessarily watching less news, because that certainly is an important component of what drives craziness in people. Right? You can just kind of go nuts all day, kind of worrying about the state of the world. You have to understand that. I think you have to really, really understand that the world's a crazy place, that it kind of always has been. Somebody tweeted the other day about how, you know, they were just ready to start living through precedented times, right, instead of unprecedented times. And I don't think that's the right way to view the world, because I think that what you're living through now is just normal history, no different than the Cuban Missile Crisis, no different than the '87 crash, no different than the 2000 crash. This is just normal history. The great thing about the stock market, though, is that it does well over time. It has its ups and downs, but over time it goes to the growth of the US economy and its companies and profits and all those things. But in the short run, the world's a crazy place. And if you just constantly digesting that on the news, that can be problematic, because you're going to think that it's always bad. And pessimism is kind of a sliding scale. I don't ever want people to go all the way down to the end, because you can't come back from it. If you land in pessimism, it's really hard to come back from it. So I just caution all of you, don't travel too far down that road, because not only is it a dead end, you can't come back. You can't come back from being a pessimist.
Very, very wise words. And also, I would say a lot of people haven't come back from the pandemic lows, not only in terms of their psyche, but also in terms of their accounts. I mean, I look at this, it doesn't seem like we have a Robin Hood crowd here, but I will say, as of the last quarter, and this was months ago, the average Robinhood account is down to $240. That's down from almost $1,000. So everybody who came in the last 2 years, most of them have lost a significant portion or all of their money. That was the average. So wise words there. Get your mental health in order. Pay attention to that. And I hope everybody has learned something, a couple of things here today. Mike, we really appreciate your time here. And we're gonna, and I said, you know what, I said we were gonna send things off on a happy note, and I think we really have here. And I just want to say to everybody, keep your nose down. This is difficult. We're all going through the basic same thing here. I'm not a short seller. I'm not making fortunes here. So we're just trying to figure it out on a day-to-day basis. By the way, that's Jerome Powell's deal too. So Mike, thank you again for coming. Thanks everybody for watching. If you're watching the replay, urge you to check out Mike's blog and also his Twitter account. You saw it on your screen there. All right, we're going to sign off here, and we're going to be back at you next month with a brand new theme and a new guest, and hopefully things are turning around a little bit.